Wall Street closed with cuts on Friday after U.S. jobs addition came in lower than expected. The Nasdaq and S&P 500 tumbled for 4 straight days, notching their worst week since March. Stocks in the Asia-Pacific trade mixed in early trade. Oil prices rise for the 6th straight week after Saudi Arabia and Russia extend supply cuts through September, adding to global supply concerns. Brent is now around $86 per barrel. Gold also rises as the weaker than expected July jobs data drags the dollar and yields. And Britannia reports a weak set of first quarter earnings. The company reports flat volume growth while revenue and profit both miss street expectations. State Bank of India reports an operationally weak first quarter. Domestic NIMs see the highest decline in 6 years. Chairman Dinesh Kumar Khara tells CNBC TV18 that he doesn't see any asset quality challenge and the effort will be to improve the margins. In a breather to hardware companies, the central government clarifies that the proposed restrictions on imports of laptops, tablets and personal computers will come into effect from the 1st of November. Import consignments can be cleared till October 31st without a license for restricted imports. Hi guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are the top headlines that we have as we get into this new trading week. There's clearly lots for us to catch up on in terms of global cues, in terms of some of the earnings that have come through for our own markets as well. But first up, as always, let's take a look at what's going on across Asia because it is largely lower over here. A few of the markets have recovered since the open, but you are still seeing significant cuts come through in the Hang Seng market. So that's down around 0.4%. You have the Nikkei, which is trading around 0.25% lower. The Taiwanese market is one where we have seen a decent recovery come through. So this one is up around 0.5%. And for the rest of the Asian markets, so that's Kospi, Shanghai, Straits, not too much of a move coming through. Kospi and Shanghai are seeing a little bit of a cut. The Shanghai market has actually slipped further, so that's down almost 0.8%. That's probably the one which is looking the worst. And the Straits also has managed to move back into the green, so that's around 0.3% higher. So very mixed cues coming through from Asia. And let's also talk about the US markets because that's where we did see some cuts come through on Friday. So we did see a lower close and the Dow was down 150 points. The S&P 500 slipped around 23 points at the close and the Nasdaq also closed with cuts of around 50 points. Now, all of the major indices reversed the earlier gains in the afternoon session. And if you look at the kind of weekly move that we've seen, the Nasdaq and S&P 500 both dropped around 2.9 and 2.3% respectively. And they've both actually notched their worst week that we've seen since March. So definitely a bit of a weak cue coming through from the US. But sticking with the US, we also saw the economy added around 187,000 jobs in July, which is lower than what was expected. And this points to a slower pace, of job additions in the US economy. We have Steve Leesman who's here with all of the highlights from the report.
Non-farm payrolls rising by 187,000 versus an estimate of 200,000. Take it all with a bit of a grain of salt because of massive seasonal adjustments normal in the month of July. May and June was revised down by about 50,000 jobs. The unemployment rate ticking down 0.1 to 3.5%. But the labor force participation rate remaining unchanged for the 5th consecutive month at 62.6%. And average hourly earnings up 0.4%, a little bit hotter than expected for a year-over-year rate that actually went up to 4.4%. The jobs were in private education and health services, which were up 100,000, with healthcare alone accounting for 63,000 of that. Financial activities up 19,000, construction up 19,000. Leisure and hospitality, which had been a big addition to jobs in the past several months, has now been leveling off, just up 17,000 this month. And temporary help, one sign of potential future job growth, fell 22,000. It has been falling steadily since October 2022. The takeaway is that the job market is cooling in the U.S. as the Fed hopes, but stronger wage gains and a very low unemployment rate should mean the central bank is still going to be wary about sounding an all-clear signal on inflation.
All right, Steve, thanks a lot for getting us all of those highlights. But let's also listen to what some experts had to say on the job sprint that came through. Listen in.
We're not going to see 200,000 or even 180,000 new jobs per month in a long-term sort of equilibrium situation, right? That's not the demographic trend. So there needs to be a gradual deceleration. And the fact that that deceleration is benign, I think, is also visible in indicators like jobless claims, which continue to be quite low. And the unemployment rate has been at 3.5% for well over a year at this point. So I would view this as a benign deceleration. The wage number was an upside surprise, and I would say it's true that in 2023, while we've seen some deceleration, it's been very gradual deceleration. The average hourly earnings numbers have been the weakest of the major indicators of wages, so there's an aspect of convergence here that average hourly earnings have been a little firmer, and the employment cost index, surprised on the downside. So these things are converging to some degree. But overall, I think wage growth is decelerating, probably needs to decelerate further for that to be consistent with 2% inflation in the long term.
Really was exciting because we're seeing continued, this would have been a blowout month or a great month of the 2010s, and it's, the labor market, we've got job gains continuing, the unemployment rate back down to 3.5%. We've got wages at 4.4%, the same as they were in May, but productivity growth has accelerated. And the data today suggests it accelerated even more than what we saw in the second quarter. And that's the elixir that makes us able to retain these wage gains as workers and not have it threaten the Fed as a spillover into inflation. And so, the idea that with fewer workers, we're still at a low unemployment rate and wages were, still there. That's just wonderful news. I mean, I'm leaning into this report. I'm worried about the bond market and the bloodbath that we've seen there and what's going on. But for the moment, I'm going to take this win.
All right, that is some important opinion that we're tracking. But let's now talk about all of the cues that you really need to look at before we get into this market open. So we have Ekta, Nigel, as well as Surbhi all here to take us through the trade setup, as well as the individual stocks that you should have on your radar today. Ekta, Nigel, Surbhi, thank you for joining us. And Ekta, coming to you first, we were just going through the global picture. That definitely seems to be a little bit weak as we kick things off.
Well, yes, we saw this trend taking place on Friday itself, but we did snap that 3-day losing streak that we've seen. So the markets fell for the second straight week, however. So on Friday, yes, we did see a recovery, but it was a loss for the markets for the second straight week. Sensex Nifty was down 1% for the week. Now, one of the cues which we need to watch closely is the FII flows, because the FIIs net sold for the 7th consecutive session, and FIIs net sold over 550 odd crores on Friday's trading session. Now, the S&P and the Nasdaq tumbled for 4th straight sessions as well. So there is some weakness which is coming in on the global front. The US jobs data, 1.87 lakh jobs added in July versus an estimate of around 2 lakh jobs. Oil on the fringe is seeing some amount of rise, so it's risen for the 6th straight week. Do watch out for that because we are net importers of oil. Asia is mixed at this point in time, and the GIFT Nifty, however, is currently indicating a marginally higher start. Whether or not we sell into this rally or it sustains, one will need to see. Now, just watch out for a couple of cues. Follow-on moves in State Bank of India, which ended close to 3% lower post its numbers. Brokerages are largely positive on the numbers. Earnings today, we have India Cement, Indigo Paint, Gland Pharma, MedPlus, Torrent Pharma. So a lot from the healthcare space to watch out for. And we also have the RBI policy this week. So we have a lot of cues on the macro as well as the micros which are lined up.
All right, and thanks for laying out all of those cues for us, Ekta. But let's also talk about the individual stocks that we should watch. We have an entire weekend's worth of action that Surbhi is going to bring us up to speed on. Surbhi, seems like there is more disappointing than positive news on the earnings front.
That's true. So a lot of miss on the versus the CNBC TV18 poll. Let's start with Britannia first. The results miss expectations. The company reports a flat volume growth versus expectations of 5 to 6%, a revenue growth of 8% versus expectations of 11% over there. Balkrishna Industries, the revenues were down 17%. The EBITDA was up 13% on a year-on-year basis. The margins came in at 23% versus 17% same time last year. Bank of Baroda, again, it was a miss on the poll. The net interest income came in at close to 11,000 crores versus 11,645 crores. PAT came in at 4,070 crores versus expectations of 4,600 odd crores. BHEL, the revenues were up 7%, but it reported a loss of 352 crores versus a loss of 192 crores same time last year. MapMy India, the revenues were up nearly 38%. The EBITDA came in at 38 crores, but the margins came in at 42% versus 46% same time last year. And lastly, Cipla is also on my radar. The company gets an OAI, which is official action indicated from US FDA for its Pitambur facility.
All right, Surbhi, thanks a lot for taking us through that entire list of stocks. We're going to watch for all of these in today's trading session. Finally, it's over to Nigel, who's looking at all of the cues from the futures and options space. Nigel, it was the second straight week of cuts for our own markets, but tell us how it's looking this morning.
Oh, that's right. The week ended in the red, but Friday ended well in the green, and the much-awaited relief rally that we're looking forward to, that came about in Friday's trading session. One of the root causes were that the FIs, they were net short, and they were forced to cover some of those short positions. Close to 5,000 contracts were covered on the short side, and they added close to 10,000 long contracts, telling you the swing factor was close to around 15,000 contracts odd. Now, they continue to remain net short, though, with close to 56% of their position on the short side. On the option side, they bought more puts than calls, but they also wrote more puts than calls. So that's telling you that maybe at lower levels, we've made some kind of near-term base. Which brings us to the two key strikes. The 19,500 put, well, that added close to around 35 lakh shares or thereabouts. The premium out there was roughly around 80 rupees. On the upside, the 19,600 call, well, that added close to around 30 lakh shares. The premium out there was around 60 rupees. So just plugging in those numbers, yes, we had a relief rally, but to get a further extended up move towards the 20,000 odd mark, we'll have to get past the 20 DMA first. So that's going to be the crucial reference point on the upside. While on the downside, last week's low, well, that becomes the crucial support zone. So you could say we're in this band of around 300, 330 points odd. We'll have to see which way it's going to break. Back to you.
All right, that is the big question. Nigel, thanks a lot for taking us through those cues. But speaking of cues, we also got some big ones last week, which is that Morgan Stanley upgraded India to an overweight. And in their first interview after that big upgrade, we have Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley, who will be with us here at CNBC TV18 in just a short while at around 8:05 a.m. So do stay tuned for that very important conversation. But with that, we do need to get into a short break. When we return, another important piece of news is that State Bank of India reported an operationally weak first quarter. So we're going to bring you excerpts from our conversation with SBI Chairman Dinesh Kumar Khara. Welcome back. You're still tuned into Power Breakfast. Now, State Bank of India reported a disappointing set of first quarter numbers. So we saw a decline in the domestic net interest margin, while the loan growth was also the weakest that we've seen in 7 quarters. My colleague Ritu spoke to the chairman, Dinesh Kumar Khara, on asset quality concerns and what the recoveries are also looking like. So listen in to what he had to tell us.
If you will compare the stress in the first quarter with the first quarter of the previous year, the stress has actually come down. And against that stress also, we have already affected the recoveries to the tune of more than 1,500 crores. It is all temporary cash flow disruptions, and which is attributed to multiple factors which we get to see on ground. There are floods, there are all kind of things which are happening. So these are some of the contributing reasons. But if I look at it, how much out of this stress, how much gets converted into NPA, that number is very small. It is somewhere around 500 odd crores only. So which means that a significant portion of this will get stressed. When it comes to retail in particular, we have to be very mindful in terms of the stickiness of the stress which we get to see. Fortunately for us, that's not the situation. I don't expect much of a challenge from the corporate book. Whatever little challenge I expect is from agri and SME to some extent. We don't have any chunky assets left out there. So these will be all small and the retail assets.
They
but
not total to
yeah, as we have seen that in the first quarter, we have seen the recoveries about 1,000 odd crore. But there is no universal or the broad-based trend. Okay. It will depend upon each asset and how soon it gets resolved. But yes, of course, there has to be consistent effort, which we are making on ground.
All right, that is a very important chat with SBI Chairman Dinesh Kumar Khara. This will be an important stock to watch as well. It was the top loser on the Nifty on Friday. So let's see how things move today as well. But moving on, in what could be a breather for hardware companies, the government has clarified that restriction on imports of laptops, tablets and personal computers will come into effect from the 1st of November. And this comes just 2 days after the government had imposed import restrictions with immediate effect for security reasons and the need to promote domestic manufacturing as well. So importers of these items would now have to seek permission or a license from the government for their inbound shipment. So that is some important news that we're tracking as well. And I also want to bring you some updates coming in from the ongoing investigation of Rashesh Shah and ARC Edelweiss in connection with renowned art director Nitin Desai's suicide case. Edelweiss has clarified that there was no wrongdoing with Nitin Desai's loans. Nitin was a promoter of the company ND's Art World and had obtained loans worth 185 crore rupees. However, he was unable to repay this amount and went into default way back in 2019. So that is an important update on an ongoing investigation as well. But with that, we are going to get into a short break. On the other side, we're going to talk all about the cues that we're getting from the commodity markets. There's lots going on there as well. So stay tuned for that. Welcome back. Let's talk all about the commodity space as promised. We have Manisha joining us as always. Manisha, it's really all about the crude prices, which once again have seen quite a rise.
Oh, absolutely, Pavitra. Morning. Yes, the crude oil prices are now trading at a 4-month highs, and we're trading at $86 a barrel. We've left behind 6 weeks of consecutive gains, and this week has started on a positive note as well. The markets are reacting to Saudi Arabia and Russia extending supply cuts for the month of September, with Saudi Arabia saying that they could be deepened and extended beyond September as well. Apart from that, Saudi Arabia also has raised the official selling price for Asia for a third straight month for the month of September. We also have seen constant decline in U.S. inventory. So you have various factors which are reacting, and the markets do believe that we are more closer to 90 right now than to 80. So the speculative long positions also seem to be increasing. But not just crude. Today is a good day because you've seen gold, silver, copper, steel, all of these commodities also open in the positive.
All right, well, at least it's a good day for the commodity markets. It, really helps when the global setup is looking so weak. But Manisha, thanks a lot for getting us all of those details as far as, what's going on with the commodities. For our own markets, we have Asia, which is still quite mixed, but there has definitely been a little bit of a recovery that's playing out. The GIFT Nifty indicates a positive open, so that's good for starters. Let's see how things really pan out from here. I'm going to wind down on that note on this edition of Power Breakfast. But remember, we have that important conversation lined up in just a bit. The big Morgan Stanley interview with Jonathan Garner comes up at 8:05 a.m. Thanks a lot for tuning into Power Breakfast. Bazaar Morning Call is up in 2.